Okay. So this is financial modeling, and then this one is about building a three financial model. So what we have been doing since all this while, as an accountant or as a graduate in accounting or chartered or whatever, you have so many opportunities that you can launch into. So many. That's why you can see so many people from other disciplines, other fields are running to our field, because as a chartered accountant, you can't be jobless. You should not be. If you are, you should not be. There are so many things you can be doing for yourself that the money will be coming in, even if you are not working in an organization. And if you are not working in an organization, as long as you go for training and you have that certificate, start working. There are so many things you can lay your hands on, even as a side project. So this is one of them, financial modeling. What I've been doing since we started is for accountants in a department. Then we can have accountants in departments. That's why you're going to be having financial reporting department and the like. Account receivable, account payable, reconciliation officer, and the like. That is one aspect. There's another department that is called finance department. Finance and accounts department are not the same thing. For some people, they mix it up by saying finance is the same thing as account. No. So the finance aspect is where we are now. So you can decide to go as an accountant. You can decide to go as a finance person. You can go to tax. You can go to tax aspect. You can go to, apart from tax, audits aspect. So your audit will now be into either you want to be internal audit or external. So many places we can go. We have long name. So now, what is this all about? This finance department, this finance department, they forecast for the future. They forecast for the future. Accountants are using historical figures. Accountants are using historical figures. If I want to prepare financial statements now, I cannot prepare financial statements of next year. I have to prepare financial statements of the previous year or previous months. That is what I can. So our own concept is based on historical concept. Are we good to go? But these people, they don't want to prepare. They will base their own calculation both on historical and assumption, future. So they will now forecast. Forecast is the other aspect of it. Okay. So what they want to do is, if in year, maybe they want to forecast for 5 years, they can start from 5 years previous year. Or let's say 3 years. Let's say they want to forecast for 3 years. It means they will start from the last 3 years. Let's say 2022, 2023, 2024. If the financial statement of that 3 is already, then they will now forecast on 2025, 2026, 2027. So they will now factor in something, anything that can influence that particular figure or whatever in the nearest future. Are we going to go? So it's very close to what we have done, not too long, but this one is a bit in a different way. This is SFM aspect. So data analysis and financial modeling are SFM aspect. Everything you are doing in ICANN, there's a purpose for everything. There's a purpose for everything. So if you are here to start now. So what we have done now here, by the time you go for class, you now be relating to, okay, when you know the practical and you are now getting the theory. It's like you are getting full gist of what you have done somehow. So. Okay, so that is how we are starting from here. So many organizations now want to know what is going to be in the next 3 years. Or I want to go into a particular project. I want to go into a particular industry. Okay. Maybe I want to go into a manufacturing of a tire or whatever. So even if I don't have previous historical figures to build on, I can use industry average. I can go to companies that are into that particular product and business, get their financial statement in the last 2 or 3 years, then use that information to build my own for how many years? In the next 3 years. So if they're getting 1 million per month or per year, I can look at it. If they are making this 1 million naira, will I be able to make that 1 million naira? What is their capital base? What is the revenue? What is their production? How much they? So I'll be able. There are so many factors we are going to have before we can decide that this is what we'll be able to. Okay, so we are talking about the 3 financial modeling. We are talking about the income statement. We are talking about balance sheet, which is statement of financial position. We're also talking about the cash flow. So 3 linked together. So when we are also talking about this modeling, we have 2 colors that we use. We use black color and blue colors. Okay, we have one coded and not coded. So anywhere you see formulas, we use what? We use black for it. Anywhere we use blue color, it means there's no formula on it. Just a normal thing. And we do that. Many people are into it, getting money from it. You can even go to companies. If you go to Dangote company, you will see complete department. You will see account department, you will see finance department, you will see tax, you will see internal audit. There are some companies that they have tax in their company. There's tax department. Yes. So they deal with tax. There's accounts, they deal with accounting record. There's finance, they deal with finance aspect, forecast. So we have internal audit there, sure. Then external auditor will come from us. So that's a complete company. Okay, let's start. So this is what we want to build. And that is how it's going to look like. So that is our mission. You can see that we have like how many years there? We have so 4 historical information and 4 forecast figures. Do you understand now? And after that, we are going to put it in a normal presentation like this so that you can see that. So let's move on. So this is where we are going. So a financial model is a tool used to forecast a business. So financial performance into the future based on historical data and what? An assumption. So it has to be both the historical. So we will now build on that historical, like incremental, that this is likely what they are going to achieve in the next 4 years. But the thing is that assumption you are using, because they are not real, you must make sure that assumption are coming from a genuine source. Because once you are done with this, it's like you are signing financial statement, audited accounts as well. Because whatever you give them now, they can take this thing to bank as a proposal. They want to get 20 billion naira. Want to get 20 billion naira. So this is what we have in the next 5 years to come. So bank will sit down, will look at it, audit it. But the thing is that the assumptions you are going to use here has to come from the management. And you also have to audit that assumption. How are we sure that this assumption you are giving us are what? Are genuine? You said you have been making 1 million naira as revenue in the last 4 years. And now you said you want to double the revenue to 5 million naira. How do you want to perform magic? So they will tell you no. These are the things we put in place. So we want to open more branches. So we are only operating in Lagos as at now, but in the next 5 years, we want to make sure we spread over to like 5 states. And this is our plan. So if you are satisfied, tick that and make sure all the assumptions are okay. Okay, so this is what we want to build. Then the next one is why do we build these financial models? So we have corporate decisions for a company to make decisions. So performance and also for what? For strategic planning. So you can start planning that in the next 5 years, it's like a roadmap for them. Now this is what we want to do. This is what we have planned. This one is more different from budget. It's very close to budget, but budget is like within 1 year. But this one can be for 5 years. Budget is just for 1 year. That's can be quarter or 1 year. But this financial modeling is very close to budgets, look alike, but it's for a longer time that you'll be working towards as a roadmap and make sure you achieve what you have in that. Then it can also be for projects. If you have a project that is going to take long, so you prepare that one by one. Then you also have corporate transactions, investment decision. Mostly they use it in the bank. Want to go for proposal and the like. Okay, so I don't want to take much time. These are the types of financial modeling we can do that we have. We have plenty of them. Like that budget model is like what we just finished. Then forecasting model, option pricing model, but we are doing the 3 statement model. That is the most common one. So if any organization wants to do financial modeling, you will do the 3-1 for them. Because that one we talk about their forecast, the focus on their revenue, focus on the income statement, on the balance sheet and the cash. And that is what. Okay, so let's just take it more one by one. Then the merger model now. If you want to acquire a particular acquisition or want to merge together, prepare your own. Let's see. And let's see before I start putting my money into, so that the money will not just disappear. So we are still talking about the same thing. So we have the statement of 3-statement model. That is the top one. DCF, scenario analysis. We all know sensitivity analysis now. So everything in PM, don't be waste.
Not only PM.
Some people, yes, no. Some people will say, I don't know why they are even setting that linear programming. Why they are setting that something that is not useful. That's the level you are. So if you move forward, you see that it's useful. Okay, so when we are building the model, we have 3 processes. So the first one is what? You have to put the input. After the input, you process, and then you get the output. The output is more like the chart. It's more like a chart, the visual you are going to have. Because most of these organizations, most of these are managed, our CEO and directors, they're not used to figures. And we are going to see a lot of figures. You can see how that's what we want to build looks like. So by the time they look at it for like 1 minute and 2 minutes, they don't understand. They'll put it down. But if you can do the outputs, the graph for them to see, charts to see. At least they can see how this thing is going up, so they can look at it. In year one, will be a bit low, but I can see that we are growing, the chart is growing up to the, and they also call you to come and explain some things to them. So when you want to put the input, it must be clearly what? Identified. It should only ever be entered once. So this input is your assumptions, all your assumptions. Then the process, make sure you follow the easy process, so that when you are linking it together, it will not be difficult. And if there's an error, you can just go back to the first number. Once you change it, it will flow through all the places you have linked together. You will see the way we are going to start doing it tomorrow. Okay, so we have best models and simple. So make sure you make it simple. It can be complex, but make sure you make it simple for yourself and for those who want to use it. Okay. So for the outputs, provide the key results to add decision making, easy to understand, and unambiguous. So the way we are going to do our graph, just the same way we started our Excel sheet aspect, making it our disburse and the see by putting it in the charts, in graphs. So those are the things we are going to do together. Okay, so this is what it's going to look like. But I won't do it this way. If I do it this way, I won't do it like the second one. I'll do it like the first one. The second one, it was done on one sheet, on a single spreadsheet. Then you now use something to demarcate. Once you click on that plot, it will show the other one. Once you click on it, it will disappear, it will close the page. But I won't do it this way. I will do it like our management account. We'll be creating sheets by sheets so that we link it together and it will continue to flow together. So this one is easy because you can actually print it out. But this one, you want to print it out to give you headache, because the sheet will be too long to print. So we have assumptions. These are the area we are going to cover. The assumptions and the drivers. The assumption, if they want to increase the revenue month by month, so we have to be sure of that assumptions. Then the driver as well, historical ratios and figures which drive the what? The forecast. Which drive the forecast. So we are going to start with historical. Then we will now build on that historical based on the assumptions we have. So once we are done with that assumption part, we will do the income statement, and that will be the summary of the profits or loss. Then we have balance sheet. This will display the company's assets, liability, and the shareholders' equity. Then we have the cash flow statement. So the reports to generate the inflow and outflow. Then the last one we are going to do is what? Is supporting schedules. So this supporting schedule is talking about the PPE and the debts, if there is any repayment or there is addition to PPE. So this is this step we are going to follow. Just make sure you grab these 5 steps. These 5 steps. Okay. Historical data is first thing we need. How do we get this historical data? It's from the audited accounts. So it's like where accountant stops, that is where the finance will start from. So if I want to model for 5 years. I will use audited accounts of previous year. The last previous year, I will stop there. Then I will now start using that figure to build for the 5 years I want to build. So finance depends on what? On the accountant. Because they cannot start from scratch. They have to start from where that is stopped. So that's why we need historical data. So historical data, who is going to supply? Accountant will supply. Then from there, assumption will now start. Who is going to give the assumption? The management. And you make sure that you have done your verification on that. Then you will now start to forecast for the revenue. Based on the assumption given to you, you will now start doing the calculations. You start adding and subtracting and the like. Then once you are done with that, you also do the schedule of the PP and the debts. Then forecast capital structure. Then you complete the cash flow. This is the step. The cash flow is the last one you are going to do. This is the step we are going to follow. The step 1 is the historical data. You must get that financial statement from them. Then assumptions. You use the assumption to build, to prepare the forecast. Then after that, you will forecast for the revenue and for the cost and every other thing. Then forecast for working capital. The working capital also will be given to you. Then forecast for capital assets and the like. Don't worry, by the time we start, we'll be all right. Let's leave this one. So for example, if your revenue is 100%, are we together? It means cost of goods sold is 80% and gross profit will be what? 20%. Addition of the two must equals to revenue and like that. Then we also have sales of goods and what? I mean selling and distribution, Abi, or admin, whatever. Then you have operating margin, 50% and the like. So it's not more than that. Then we'll be looking at this one when we get there. That will be working capital equation. We remember all this now. I've done all the formula in one sheet. Once I share with you, all these things are there. But if you want to do your receivables, we all know that is account receivables over sales multiplied by 365 days. Then the same thing to payable, the same thing to inventory. Okay, this one is for receivable days. There's accounts receivable days. The next slide is for inventory. Then the next one is for payable. Okay.
This thing I just repeated was what I can compare to 2 times ago.
I know.
When they said we should use the company.
Working capital.
Well, the growth is that in the twisted it form of 2-point analysis.
In form of what?
They said we should use 2-point analysis. That's why we should do forecast this, forecast that.
I know. So it's normal working capital. So it's still the same step we are going to follow. Historical, forecast, and we have PP, CapEx. You know the meaning of CapEx now? Capital expenditure, depreciation, intangible assets, as many as we have. We'll work on that. Okay, then after that, we go to where? We also go to capital structure. The capital structure is talking about how is the organization being financed? Is it through debts and equity or only votes, all combination of votes, as the case may be. Then we can now have circular references. We can have opening debts, hard repayments. I mean less repayment or add addition, then plus interest. Then whatever you get, that's the closing debt. That closing debt is what we are going to have on the balance sheet. Okay. And at the end of the day, we arrive at this. So a financial model is a tool that relies on a set of what?
Assumption.
Just assumption. So maybe at the end of that 5 years, not meet up with it. But it must be your assumption, which you are going to use to build, must be realistic. Must be realistic. Must be realistic.
So how do we determine a realistic assumption?
When management are giving you their assumption, you will also audit it yourself. Maybe what they are saying makes sense or not. You have been making 1 million, 1 million, 1 million, or you have been running into loss for like 4 years. And in their assumption, they said they are going to make 50 million in the next 5 years. How do you want to do it? Tell us. Is it realistic? Then they will explain, these are the things we have to plan. We want to get additional shareholders and the like. So if you are good with this, you accept it. So this is the step we have to follow. So, and this step is very vital. And make sure you follow it to the last letter, to the very last letter. They say copy and paste
Raw data.
raw data in the blank model. What is that raw data talking about? The historical, the audited account they are going to give you for 4 years or 3 years or 2 years. Copy it on a what? On a blank Excel sheet. The second step say format and link historical subtotal. So you are not going to have like the way we did our gross revenue. How do we mute your mic, please? We added it to what? To our revenue. That is revenue minus cost. Give us the gross profit. So when you know that gross profit now, there's formula on it. So that's what they're saying. Format and link. Then after that is calculate historical what? Ratios. You calculate historical ratios. All the formula for ratios are there. Then make assumptions based on the guidance provided. What is the guidance provided? That is the assumptions by the management. Are we good to go? Then start the income statement. You will start with your income statement. The steps are there for us to follow. We are just following the step one by one, and we are doing what's supposed to do. Then the next one is start the what? The balance sheet. Once you are done with the income statement, the next one to do is what? The balance sheet. Then after that, they said build supporting what? Schedules. So you will do the supporting schedules. Then after that is build the cash flow statement and complete what? Income statements and balance sheet. It means you cannot complete income statement and balance sheet if we are yet to build the supporting schedule. Because the depreciation will affect the amount you are going to put under the assets. And it's also going to affect the debts you are going to put. So you have to know the closing debt and then the closing asset you are going to have. Then depreciation will go into income statement. Interest also will go into income statement. That is why you have to finish this before you conclude that. Then when you are done with all this, then create charts, graphs, and outputs, whichever way you want to use. Maybe charts, maybe pie charts, maybe whatever else, create it and present it to look in that way we have. So tomorrow we just start the case. I will send it today, so including this and all the material we are going to use. And this is what we want to do when we meet tomorrow.
Thank you very much, sir.
Yes, sir. So I believe we'll finish it tomorrow. Online, any issue? Are we good?
Thank you.
Yes, sir. Thank you, sir.
All right. So
Yeah,
let's.
hello, Mr. James.
Yes, sir.
Yeah, sorry. What time are we starting the task promise tomorrow?
It's not tax program tomorrow. We are doing this.
We never finish with financial with the good tax
Because based on our timetable, I think tomorrow should be tax promise.
It's because of It's because of the timing. So we have to finish this one, then we now start tax man next week. But we'll make sure we close.
Okay, next week.
Yes.
Okay.
It's reasonable. It's not bad.
So that my heart will not be on.
All right.
All right. So I'm going to send out the materials we are going to use today. Yes, exactly.
Thank you, sir. Thank you. The materials. Thank you.
Please, I send the budget to.
Yes, I will send it. I will send it.